Thank you, Jen. Good morning again, everybody. I want to introduce Tim Ryan, Vice Chairman, Markets Strategy and Stakeholders Leader for PwC, and Andrew Winston, the founder of Winston Eco Strategies. I want to start off by asking each of you very briefly, about half a minute, to explain who you are and what your business is. We'll start with you, Tim.
Yeah, so I'm with PwC. I head up our stakeholder function, which means that one of the things we realized at PwC over the last several years is our stakeholders go beyond just our clients and the boards we work with. We work with the investor community, work with society at large, the political world, academic world, and a number of other companies and constituents that we work with. At PwC, we help companies transform their business models to deal with some of the challenges that we have. And we also help our clients measure the impact of the environment and also the value that that has to their various stakeholders.
Terrific.
Great.
Andrew?
It's good to be with the Vice Chairman. I guess I'm the Vice Chairman of Winston Eco Strategies and Chairman and Secretary. So I'm a consultant by trade, but I think my mission is to help really large companies navigate and hopefully profit from the world's mega challenges, in particular things like climate change and resource constraints and transparency. And I do that through some consulting. Coincidentally, I work with PwC for part of my time, and through advisory boards to companies like Kimberly-Clark and Unilever, and through a lot of writing and I guess journalism of a sort. So I co-wrote Green to Gold, a book that many of you probably know, and my new book, The Big Pivot. So there's my plug for the moment.
So the question that we're to tackle briefly this morning is whether sustainability delivers shareholder value. And Andrew, when I asked you this question ahead of time, you said, I don't like the question. Please.
I thought I said it nicer than that.
You did. You did.
I guess, well, I first just want to kind of establish that I think there is no conflict between shareholder value and sustainability. I think none. What there's potentially a conflict between is short-term definition of value, which is currently defined in the market as short-term earnings, which is not the same as the value of the enterprise. I think over time.
Hang on, you're changing the subject. Why is short-term value bad? There is a conflict. If I can make a lot of money right now, that may well be in conflict with what you think is doing the right thing, no?
Well, I'm not talking about doing the right thing. I'm talking about doing the right thing for business, and that includes both short and long term. And there's a massive amount that falls into the short term that companies do all the time. I think most of the companies in this room have found massive eco-efficiency opportunities worth not small amounts, but significant portions of their energy waste, water use. That saved a lot of money. There's also some longer term investments that potentially you have to think beyond, say, a 2-year hurdle rate. The question is how we're defining value and how we're defining return on investment, and why a 2-year hurdle rate for some kinds of investments. There's a whole bunch of things in there. But I think the assumption in the question, and this is why I have the problem, is that the costs of not doing something on sustainability are somehow in the distant future. And the costs of doing it are right now. And that's just not true. I mean, I think in the Times this morning, there was a great quote from Governor Inslee in Washington saying, climate change is not a next century issue, it's a next half-hour issue. Like, the costs to business and society are now. So the benefits of doing something, of reducing those costs, are now as well.
Tim, what I want to probe with you, could you hold forth a little bit on new ways that we can and should be measuring things like value, but other things? What are you and your clients focused on?
So, Adam, first, let me take a step back and tell you what we're hearing. We're hearing, because we often hear in our world about disclosure overload. We hear, as we travel the country, I'm sure you feel it in your businesses, too much information. Regulatory filings are hundreds of pages. And while that's true in some respects, what we're hearing from investors on this topic, the topic that Andrew just talked about, is they actually do want more. We just issued an investor survey around sustainability, and over 60% of investors said they're frustrated with the lack of disclosure around environmental sustainability issues. So there is a cry for this, and it has gone mainstream. And specifically to your question, what they want is they want to know more about the risks, but equally important, they want to know more about the opportunities, and they want to know how companies stand against peers so they can do peer-to-peer comparisons. And they were very loud and clear in that survey that we just published within the last couple of weeks. Equally interesting is we've done a number of sector-specific roundtables, and investors are getting very granular around the types of things that they want to see. So they want to see, Doug Baker just talked about water, they want to see what are companies' long-term plans around water, for example.
Let me play devil's advocate with you. Let's say they say they're interested, they want more information on X. First of all, what if they're just saying that? And what if what they really mean is, yes, we're interested. By the way, we're way more interested in, are you going to make the next quarter?
Yeah, so look, we touched on this last question. They can say whatever they want, but they vote with where they put their money. So another question we asked in the survey is where do you factor in sustainability in your investment decisions? And what we found is over half of them do consider a company's posture around sustainability, particularly around long-term strategies in their investment decisions. And it's not just small investors. What we found is that over a third of investment houses with $100 billion asset management or more, they're making decisions based upon what a company's postures are on this particular topic.
But to either of you, they're making decisions based on it, but where does it rank? If it's number 18 on the list, it's less impressive than if it's 1, 2, or 3.
But I also think we should step back for a second and say, who's the they we're talking about?
We're
Which
talking about
investors? Which investors? Because there's the short-term Wall Street buy side. There's that care just about the quarter or less because that's what they're measured on as well. And by the way, as you know, over half, I mean, the Wall Street that we think of is no longer in existence. If you read Flash Boys by Michael Lewis, which you should read right after mine, is an amazing, amazing book because over 60% of the shares now are traded literally in less than a blink of an eye, right? So who's the they we're appealing to here? And so there's the institutional investors who do care about longer term because they have things like pensions that they're supposed to keep in place for generations. And then there's people just trading like a casino. So I think, who are we? For the casino types, yeah, this stuff, if it seems like it's a long-term payout, won't matter at all to them. But that's up to the companies, I think, to go to investors and explain how sustainability investments, or what you want to call it, whatever you want to call it, ratchets back to today's benefit, medium term and long term, how it creates business value over time. That's a conversation that we need to have, and we need better numbers to put value on things we don't put good numbers on today.
So I'd like to hear some specifics about some things that we're either measuring now or we could be measuring now. How can we improve?
So a couple of things that we're measuring now is when you look at the total environmental footprint. So when you look at, for example, the social cost of an action a company might take, those are things that very few companies today are measuring, but that's a growing trend. So for example, somebody's going to put a plant in a certain part of the world. What's the social impact? What's the social benefit of that? That's a very specific example where you see companies now measuring that or beginning to build in their cadence of how do you measure that type of thing to value and measure returns in a very different way than we have in the past.
Andrew?
Well, I mean, I think there's a whole range of things that we don't put numbers on, and I'm not talking about externalities. That's a whole other category. I'm talking about internalized value to business that we just don't put good numbers on, like employee attraction and retention. PwC actually just put out one of the first numbers I've seen that tried to connect the value of CSR activities or being involved as employees to the company, and it was $160 million a year of value to the business in lowering retention, improving retention, lowering retention costs. There's employee, there's customer loyalty, there's risk reduction, there's resilience benefits for companies. I mean, there's a whole range of things that are actually now, I think, the majority of company value, and that's proved out in the marketplace. Market cap is a smaller percentage of that is actually book value, much less than it used to be. So we're actually not putting numbers on the things that are now the majority. That's kind of a huge gap, right? And how do we invest in the right things that create value?
Either of you, what's holding us back? What are the barriers?
Well, things that are hard to put numbers on are hard to put numbers on, right? They're not, it's apples to apples. And this is part of the reason I work with PwC is to try to borrow or use or leverage some of their tools with clients on how you put numbers on hard things.
And I would just add to that, and we touched on it, the hardest challenge is CEOs that we talk to is balancing the short term with the long term. I completely agree with Andrew's point around you have to decide which investors you're going to engage with in a certain way and talk about long term because others don't want to have that dialogue. But then it's balancing the short term and the long term. Some of these decisions and discussions they're having, there is a true, clear long-term payback, but it's over the long term. And as we talk with CEOs and boards, the biggest challenge they have is balancing the long term and the short term. We think they're doing a good job, particularly when you look at the results over the last 5 years and how well business is done. But that is a struggle still companies have when you try to balance that short term with the long term.
Yeah. Is Mindy Lubber in the room? There she is. Could you stand up and introduce yourself and what question would you like to ask the panel?
I'm Mindy Luber. I run
Luber, pardon me.
No problem. Run an NGO out of Boston called Ceres. And we did just look at the Russell 1000 or 600 companies. Are they gaining ground? Are they doing more on sustainability or not? The result is a little bit of gaining ground. I think we're seeing some of the same questions of short-termism, long-termism. The question I would have is, until you call these things real risks, take water risk as a sustainability risk versus a business, financial, material risk. No company could run a manufacturing facility without water. No company could deal with some of the catastrophes of climate. So I think we've got to get it out of the ghetto, if that's environmentalism, into the sustainability risks or real fiduciary risks for boards, for CEOs. How do we get, the data is there. The data from Harvard Business School that you could get competitive returns from Deutsche Bank. Cost of capital is cheaper if you're a sustainability leader. It goes on and on. For you as the spokespeople here today, how do we integrate sustainability at the board level so it's a priority for the company? As part of compensation for CEOs, which we're seeing Intel and others doing. So it really is integrated systemically. And how long is it going to take till we get to integrated reporting? We've got 6,000 companies or so doing sustainability reporting, every publicly traded, and every other company doing financial reporting. There's an effort to integrate that, so we're not seen as sustainability, the soft risks, and then there's the real financial stuff. How long is it going to take for us to adopt integrated reporting?
Yeah.
Tim?
I think it's May of 2017 is when we'll get there, right? Now,
Yeah, I mean, I'll go first and
Yeah.
we can jump in. So first of all, those are all the right questions. And for a lot of us who have spent years looking at this, you do wonder why it's taking so long. But the reality is progress has been made. Just to give you another data point, this investor survey that we just did, over half of the investors were aware of who the SASB was and what they were doing.
Tell us who the SASB is.
Sustainable Accounting Standard Board, which is one group of folks, and there's many out there, who are trying to get standards out there so you can have comparability and reporting around different companies, and who are trying to focus on these material risks that are out there.
What's the relationship between the SASB and the FASB?
There's none. So, except they have a very unique names, and that's part of their strategy.
They rhyme.
They rhyme, and they look the same. And to be very candid, that's what they're trying to do,
Right.
which is build their credibility. But what they have been doing is they've been developing sector-specific material risks to over 70 different subsectors where there's risks existing in the business. And interestingly enough, many preparers, meaning companies, are involved in this initiative. So they're not being developed just by the SASB, they're developed by the SASB and the preparer community, meaning companies. So that is preparer, meaning companies, right, who are doing those.
well, I think, just quickly, I think the answer is in your question, right, about governance and about what are the incentives, right? People are paid to do what they're paid to do. And I mean, I think it made some news that Paul Pullman, who's been the most public and kind of pulling back from Wall Street, that he made, I think, an extra $700,000 or something last year for hitting sustainability targets. Like, it was in his pay because the Sustainable Living Plan is their business plan.
I'm sorry,
So,
he runs a fund?
Paul Pullman runs Unilever.
Oh, thank you.
Unilever. Sorry, CEO of Unilever, and he's made sustainability the core mission of the company in a lot of ways, and so he got extra money for hitting sustainability targets. That's rare, and there's a few CEOs like that, but clearly it has to trickle down through the organization, that the incentives have to be there, and there's a bunch of things you can do to lengthen horizons for executives. You can take option periods out, you can take the vesting periods of those options out. There's a lot that can be done. But I think this risk question is really, really challenging because this is where you get beyond the short run and the things that are easily measured. There's systemic risk we're talking about. Like, what does it mean for businesses on the coast of New Jersey when the town's wiped out from extreme weather? That's kind of hard to put a number on, right? What's the risk of that? So I think this materiality question that SASB is working on is really critical, but incredibly difficult for companies to bring into their own business at the business unit level versus systemic. Like, who manages systemic risk?
And maybe just one other quick comment.
Please.
At PwC, for the last 2 years, we've been studying this concept of the global megatrends, and you know those as urbanization, demographic shifts, and sustainability, among others. What we've seen over the last 2 years is a real shift in the boardroom. The reality is, over the last 5 years, companies have been focusing on post-crisis environment. How do you make sure you stabilize a business coming out of the crisis? And over the last 2 years, there's been this shift around how do you think more long-term around these real risks, given these megatrends and the opportunities there. So it has been refreshing to see the dialogue shift from what I'll call how do we stabilize the ship to how do we think about long-term strategy. So it is creeping back into the boardroom, and it is taking up more and more of the agenda.
Are there other questions in the room? I'm looking for hands. What? Yes, please. The mic's right behind you. Just identify yourself, please.
Thank you, Trista Thompson, and I'm with Dell. And I'm just curious, who's doing a good job today actually measuring social impact? And I don't mean environmental or carbon, but real social impact.
Other than PwC.
Yeah, I mean, well, I think she's saying which companies are, and I don't. There's not a lot that come to mind immediately. I mean, which companies are measuring their social impact? And part of the reason I think I would say I don't know is because I guess I don't personally think and look too much at who's measuring the impact on the environment or doing the right thing. It's about the impact on the business, and that's kind of what I'm always trying to bring it back to. So it'll probably come to me later, and I'll come find you, but nobody comes to mind immediately as doing, and if someone in the room can say, hey, we're doing a really good job of that, in kind of putting a number on that social impact, I think the tools are still very, very new, and I'm working with companies starting to do that, but I don't think we're there yet.
Well, here's what I would add to that is, part of the journey that companies go through is they're measuring these things first internally. And so they're getting used to, okay, how do you measure it? How do you get consistency? How do you make sure you're capturing the right data and the most meaningful data? Where we see a movement, and we're working with companies now today, is measuring it on the internal side. The next step in this evolution is external reporting. And so I think one of the reasons we're a little short on examples now is the movement is first measuring within.
And it's anecdotal so far. Even the benefit to employee engagement is anecdotal.
Does the SEC, or can one of you give us a quick update on where the SEC stands on these issues and any other relevant government agencies? Because neither FASB nor SASB are government agencies, right? They only have industry power, is that correct?
Yeah, so with respect, the FASB does get its standard setting authority from the SEC, but the SASB does not. Right. The SEC's appetite, and Andrew, you can jump in, the SEC does not have an appetite to create new rules at this point, and partly because—
Period? Or do you mean
in this area? Sorry. Okay. And part of what they're doing, in fact, Mary Jo White, the chair of the SEC, she has an effort right now for simplification. So there's not an appetite to create new rules unless there's a drumbeat in terms of the investor community and preparer community are really talking about it, and there's a real need for it, which is why our voices, our collective voices, are important in this area. And secondly, they want to make sure that before they create a requirement, does it fit under the existing regime, which is a big part of what the SASB strategy is. They're looking at this concept of materiality because the SEC does require companies to report on things that are material. So they're looking at, does it fit under the existing regime?
They're looking at it would be the most— Yes, Mindy, go ahead.
They've got clear guidance. It's not a rule, it's guidance put in place 4 years ago at the request of 70 of the largest public pension funds whose assets totaled $8 trillion, who called on the SEC to require the disclosure of climate risk. Yeah. Pretty well defined, water risk within climate risk. The compliance is mixed at best, the enforcement is minimal at best, but it absolutely is a requirement of the SEC. We were in meeting with Mary Jo White last week, and they are starting to look at the financial filings of all the companies. It's a material risk.
But it's the way you describe it compared with the conversation we've been having. It's narrow. It's climate risk. I'm not saying it's trivial, but it's specific. Well, as opposed to social impact.
Absolutely, indeed. It's climate risk, but it's financial risk. It's not climate as an environmental, national security, public health threat. It's what it means to an insurance company, to an agricultural company.
One last question, very briefly. Is there one clearinghouse, is there one organization that has a call to action here? Is there a leader of this charge other than Mindy?
That's who I mean, Ceres is kind of the most logical. No, I don't think there's, besides that, I'm not sure there's one, one place to go. I just want to say that the question about, should we wait for the SEC or are they going to put these rules in place more than guidance is the same as about, should we wait for a price on carbon or a price on water? It's the same series of questions, and in a way, I think we can't wait. And business has to act as kind of de facto regulators on themselves and on their own supply chains, and we're seeing that anyways. We're seeing those kinds of things happen.
I have a suggestion for the cocktail hour later, which is that this would be something that the Fortune Brainstorm Green community ought to talk about and coalesce around. And so please join me in thanking Tim and Andrew very much.
Thank you.
Great. Thank you, guys.